My name is John Larson. I'm the sales director here at American Real Estate Investments, and these are my 7 things to consider when purchasing a cash flowing investment property. Number 1, appreciation or capital growth in your market. Look for markets with high population growth. High population growth drives up the price of real estate in any market due to high demand and low inventory. Always look for job growth in the cities you are looking to invest in. Research Fortune 500 companies moving into your market that will bring an abundance of jobs and opportunity. Anytime you're dealing with a market that is experiencing a large amount of migration due to job growth, it will take a while for the market to balance out the demand for property and the available inventory. As an investor, this is the perfect recipe for a winning investment. Number 2, cash flow. Cash flow is important, but do not be fooled by paper yields. A paper yield is something that looks profitable on paper, but is usually based on a high-risk, high-reward scenario. Lower-grade properties in more distressed areas typically offer a higher return on investment, but do not always perform as expected. There is also less room for capital growth in these types of markets. Generally, these distressed areas are found in and around the major inner cities across the United States. Higher-grade properties in superior areas and neighborhoods with better school districts will provide a smaller return but are consistently safer assets to own. These properties are usually located in the suburbs outside of the inner city. They produce a higher quality tenant and tend to show higher appreciation in capital growth. Although they may not provide high cash flow numbers, they are considered a more passive investment, and they regularly perform. As long as you are not losing money each month, you are winning if you invest in the right market. Number 3, tenant profile. This is simple. Lower grade properties will generate a less responsible or reliable tenant, where higher grade properties in better areas and neighborhoods generate a more responsible, reliable tenant. Remember, when you are purchasing an income-producing property, you are also purchasing the type of tenant this property will attract. Not only are you assuming more risk by purchasing in a more distressed neighborhood due to outside influences, example, break-ins and theft, you are also adding risk with the type of tenant that is occupying the home. It is very common for a tenant in a lower class area or neighborhood to go delinquent on rent payments, move out of the property without notifying anyone, and damage the home. One bad tenant can easily swallow up an entire year's worth of cash flow from missed rent payments, vacancy due to constant tenant turnover, or tenant-induced damage to the property. Investors must take this into consideration when investing in a cash-flowing managed asset. Number 4, vacancy. Vacancy is an assumption you should always consider when calculating your return on investment. When investing in a lower grade asset, you should make sure to account a large portion of your net income to vacancy. Research shows that properties in more distressed markets produce a higher rate of vacancy. This is due to many factors. First would be the type of tenant a lower grade property generates. In most cases, these tenants are Section 8, which means they are provided assistance from the government for low-income housing. Since these tenants are not actually paying out of pocket to live in the home and have no financial liability associated with the property, such as a security deposit, they are more likely to vacate at their own will. Most of the time, they do this without notifying the owner or anyone from property management. Statistics show that tenants who rent lower grade properties in more distressed markets only occupy the property for 6 to 12 months on average. This is primarily due to eviction for non-payment of rent or breaking the guidelines of the lease. This causes a lot of headaches for investors. Each time you turn over the property, it costs money in repairs and leasing fees to your property manager to get the home rent ready and procure another tenant. As I stated before, properties located in more stable areas and neighborhoods that rent for higher prices produce a more reliable tenant. Generally, these tenants have higher paying jobs and bring in a larger sum of household income. In most cases, these tenants take better care of the dwelling because they are concerned with getting their security deposits back. Not all people who rent in better neighborhoods are exceptional tenants. However, it certainly does mitigate the risk for early departure or eviction. Number 5, rehab quality and maintenance. Make sure you're purchasing an investment property that has gone through a quality renovation and has been inspected by a third-party inspection company. This is extremely important when calculating your return. A property that has underwent a total renovation and has passed a third-party inspection should cost you little to nothing in maintenance expenses, especially in your first year of ownership. Most legitimate turnkey property providers will issue a 90-day to 1-year warranty if they have done a full renovation and stand by their word. Be wary of companies who will not stand by their work and avoid warranties. This usually means they have cut corners on the rehabs and are not providing their clients with a true, fully renovated turnkey asset. Pay attention to the estimated life left on the roof and all mechanicals, such as air conditioning, furnace, and hot water tank. You should avoid purchasing a home with a roof that has less than 5 years of life remaining. Ideally, you want your roof and mechanicals to have at least 5 to 10 years of life left. I found this to be a good benchmark that can help avoid costly repairs in the near future. Number 6, property management. Property management is the greatest factor in keeping an investment performing at its highest potential. As an investor, your property manager should be your eyes and ears on the ground. A good property manager watches over your investment like it's their own. It is not uncommon for a knowledgeable investor to interview 2 to 3 different management companies before making a final decision on who should be responsible for their asset. I've seen many investments fail due to poor management. When searching for a property manager, you want to look out for these key things. Number 1. How many homes do they manage? Number 2. How many property managers do they employ, and how many homes are allocated to each property manager? I have found that safe number is approximately 200 to 250 homes. I believe this number to be industry average. If a PM is watching over too many homes, there is an extreme likelihood that they are not giving each property, tenant, and homeowner the necessary attention that they deserve. Number 3. What type of infrastructure do they have in place? You want a PM that has departments in place for all different aspects of the business, like leasing, marketing, maintenance, utilities, customer service, insurance, etc. This way things are not mishandled and forgotten. It is very easy to have an upset tenant on your hands if the property manager is not readily available to your tenant's questions, concerns, or maintenance requests. Number 4. What type of properties do they manage? Ask for a description of an average property that they currently have under management. There are many property management companies out there that specialize in different types of properties, single family, multifamily, and commercial. Many property management companies also have a certain criteria that they abide by. For example, some companies will only manage properties that rent for $1,000 per month and above. Some specialize in managing lower grade assets in more distressed inner city areas. Just be sure that whatever type of property you invest in, you do your homework and match it with the right management company. Number 5. Does your PM have an online system in place? In today's world, we all want information fast. We like to track our packages to see when they arrive. We like to keep track of our banking information on our phones. Why wouldn't we want to keep track of our investment on a smartphone or a personal computer as well? Almost all of the great property management companies I've worked with over the years have an online portal set up for their owners and tenants. A place where owners can track rental payments and maintenance requests. And on the flip side, a place where tenants can submit maintenance requests and pay rent. This helps with keeping everyone accountable and on the same page. And finally, number 7, exit strategy. When investing in any type of real estate, you should already have an idea of an exit strategy from the very beginning. As an investor, what are you trying to get out of this investment? Are you looking for long-term cash flow through building a portfolio? Or are you seeking an investment in an appreciating market that you can hold for a short period, then sell to cash in on the capital gains? Whatever it is, you need to have a plan. If executed correctly, you should be well on your way to becoming a successful real estate investor. Once again, this is John Larson from American Real Estate Investments, and these are my 7 things to consider when purchasing a cash flowing investment.